Think you can't buy a home because of your student loans? You're not alone. This is one of the biggest myths out there. But here's the truth. Having student debt doesn't automatically disqualify you from becoming a homeowner. You just need to know the rules, how lenders are going to treat it, and what loan programs actually work for you. So let's break it down. I'm Ashur, Abenjamin. I'm a loan officer and an educator. I work alongside first-time home buyers all the time, and I've helped many clients with student debt buy homes. Today we're tackling the question, can you still qualify for a mortgage if you've got student loans? Spoiler, yeah, and I'll show you how. Now, student loans are all over the news right now. Repayments are coming back into play, and it's scaring a lot of people, especially home buyers. But it really shouldn't. A lot of people assume just by having student loans, you're automatically rejected for buying a home. But lenders aren't looking at your debt in isolation. What that means is they're looking for your debt and comparing it to your income. They're looking at the ratio of how much money is going out versus how much money is coming in. This is often referred to as DTI, debt to income. It's not just about how much debt you have, it's about how much monthly income you have compared to your monthly payments. So the real question is, what does your student loan payment look like? How does it compare to your income? Let's talk about how different lenders and different loan programs will look at your loans, because not all of them treat it the same. For FHA loans, if your student loans are still in deferment or have a zero payment, lenders will count 0.5% of the total balance as your monthly payment, even if you're currently paying zero. Well, what does that mean? So let's say that you have $50,000 in student loans right now, but you don't currently have a payment on it. FHA will take that $50,000, take 0.5% of it, which is $250, and that is the part that's going to affect that debt to income ratio we talked about before. Conventional loans, we have two different types of conventional loans, Fannie Mae and Freddie Mac. These will differ a little bit, where Fannie Mae will require 1% of your balance if you don't have any payments or it's in a deferment, where Freddie Mac will offer 0.5%, just like FHA does. And take note, if you're on an income-driven repayment plan, otherwise known as an IDR, they're going to use your actual monthly payment on your credit report, even if it's $50 or $5. Now let's look at VA loans. If you're a veteran or active duty, VA is actually the most generous. They might exclude your loan payment completely if it's deferred for 12 or more months. USDA loans are similar to FHA. They use 0.5% of the loan balance unless you can prove a lower fixed payment. And because everything is so different when we look at different loan types and different lenders, this is why having the right lender and loan officer matters, because different loans can literally change your approval status. Okay, so now you know how lenders calculate it. Here's how you can take control. Get a pre-approval early. Before you fall in love with a house, know what you can qualify for. Consider an income-driven repayment plan. If your loans are in deferment or forbearance, switching to an IDR can reduce the monthly amount lenders can count against you. Pay down other debts. Even if your student loans are big, lowering your credit card or car payments can improve that debt-to-income ratio and help you qualify for that house you really want. Now, increasing your income, this is easier said than done. But sometimes a small side hustle can tip the scales in your favor. And if you start that hustle a year or two prior, we can use it when it comes time to buy a home. I've had clients who were told no at one lender, came to me, we restructured their file, and got them approved with a smart plan. One of the biggest fears I hear is this: I already owe so much, how could I take on a mortgage too? But here's the thing. Rent's still going up on average around the country. And every year that you wait could mean that home prices are now increased, and that's more money that you're missing out on with that gained equity. Owning a home is one of the few ways to build wealth while you live your life. Even with student loans, you can lock in your housing costs for 30 years. You can build equity. You're benefiting from appreciation. You can create future financial flexibility, like using a line of credit or refinancing down the line. Student debt doesn't mean you just can't move forward. It just means that we need to be strategic. So if you've been told you can't buy a home because of your student loans, don't give up just yet. You might just need the right plan, the right loan, and someone knows how to make the numbers work. Want to run your numbers with me or just explore what's possible? Schedule a free strategy call on the link below, or drop your questions in the comments.